example, just as an example. If you see that we're at 405 or 46 or whatever, and you have 410 or 415 calls, and the price is not moving, but those calls are going up, that means that there's some kind of interest on that. We're gonna go over that a little later, maybe not today, but we're gonna go over on like how to actually trade off of premium trading, like actually trading the premium on the calls or the puts. But usually that's how I follow the trade sometimes. If I'm looking at the options, it's not just looking to see at what price it is or what kind of open interest it has or what kind of volume it has on each call or put. Usually you can actually determine, even without seeing the trend or whatnot on the chart, you can actually determine if you're going to make some kind of money on it or not. It also depends on how long you want to be in the trade. Um, Again, so let's start with the volume. So volume analysis, it really depends on the time frame. The daily chart for a balanced view. So the daily, it's always just pretty much like a like an indicator for me. So if you look at Tesla right now on my screen, you can see that, this is a trend that I kind of drew a little while ago, but you can kind of see we're following on this trend, and right now we're actually crossing down. It's not fully down yet. I would say this is pretty bearish going into next week, but obviously we have earnings next week, so it could just be a juke. They might just be juking people out of their shares or their calls or their positions, and then they're gonna skyrocket the price. You never really know. But if I was to take a position into next week, I have a lot of comments. This is not really ideally what I would like for it to do. But if I was to take a position next week, I would probably just do like a straddle on this. So meaning that I'm thinking that it might go up or it might go down, just like everybody else. Now, what I mean by volume, I go to the daily, and then I see the volume candles and see how much volume there was on that day. So on Friday, there was a lot of volume. I'm gonna go ahead and go and go into that day, the specific day. So let's just check the 30 minute. All right. So if we look here, the first candle, we saw it. It was up and down. This is a 30-minute candle. Up and down. That's about 8 million volume right there. The next candle, 5 million. That one kind of stayed the same way as the other one. And then afterwards, we actually tried moving back up. This is where it started, where my marker is. We tried moving back up, but we actually ended up like giving it up. Now, I look at the volume as far as like what kind of volume is coming into each one. If you see the volume is somewhat decreasing, but a little bit later in the day, this type of volume actually means something. So if you have 2 million here, and I'm gonna add the EMAs in a minute, which is what I trade, you'll see why the volume started decreasing and kind of stayed around three. But some of this in the aftermarket, I never really take a look at. I look more for like the first volume spike right at the close. So 4 o'clock at 4:30, I see what the candle was and how much volume it had. It was a green candle. It had a decent amount of volume. I believe it had almost the same amount of volume when it first opened, the third one. So I go based on that. This one didn't really have a lot of volume, meaning that people were overbuying here. So some people bought a little bit farther than the price actually was. So if it was like 405 or 406, somebody hit the button and they bought at 408 or 407. That's usually what that tells me. Um, so after I look at the volume, I start trying to identify the downtrend or maybe like a potential reversal. So this, we're going up. We're kind of staying, kind of lingering here on the second candle. This to me here, this candle right here, the third candle, this is pretty much telling me this is a pretty bearish candle, even though the next one might seem like they tried picking it up, but it just got sold off. To me, this is a trend break. I'm gonna go ahead and put the EMAs right now. So once we break over here, to me this is a downtrend. So we're breaking it down to the downside. So this is not where I want to grab calls. I want to grab calls around here on the third, which is the confirmation. I'm gonna go ahead and add the EMAs. I usually trade the 90 EMA, the 50 EMA, and the 200 EMA. So what I like to do with the indicators, especially with the 90 EMA and the 50 EMA, the 90 EMA represents a short-term momentum, meaning that if it goes under the 90 EMA, it might stay under. but I actually like a confirmation under the 50 EMA. So if the 9 is crossing the 50, then that's where I would usually like to grab puts. It works most of the time. I think maybe like 70 or 80% if I actually wait for my confirmation. Sometimes I jump in because I kind of see what happened in the past, like as far as like the chart before. But see, kind of similar over here on this side. So on here, I would have probably just grabbed puts over here once we broke down again under this. I'm gonna put a little line here, see where that leads us on the other side. So over here, I would probably grab puts around here, and then I'll write it down. As long as we don't go over here, which it never did, then I will stay in my puts. I would have probably swung. Same thing here. If I would have swung puts, I would have made some decent money there. Now you're talking about maybe I would have probably sold over here. So this is a $10 move, which would have given a pretty decent amount of gains there. All right, so let's go back to Friday. So we're gonna go to studies, edit studies. We're gonna add the I like the legacy EMA. So the legacy EMA is gonna be right here. We're gonna do the 9 EMA. That's fine. We're gonna put a blue. We're gonna put a thickness of 2, just to make sure that we see it. And then we're gonna do another and another EMA. So we're gonna do 2 EMAs, 3 EMAs, 50. We're gonna do this one yellow. We're gonna do this one actually green, and then we're gonna do this one as 200, and we're gonna do this one yellow. Same thickness on all of them. We're just gonna hit OK. All right. So we said that this one is the 9, right? So as soon as the 9 crossed under the 50, you see here this was the break, which is I think this is when I said that this was probably the downtrend, right? You see the break over here on this side. So this was the break, but that's not where I grabbed it. I would grab it exactly like around here, maybe even here, to be honest, just to be safe. But this right here would have been my breaker structure. This is still kind of lingering in the air, as you saw this candle here and this candle and the third candle here. This one went all the way back up, so you would have lost some money here on the put. So confirmation here on this one, where I'm putting my marker right now. That's when you would have made money there. So EMAs, you see the 200 EMA on the top. It kind of just bounced off of it a couple times and went over it, but really these candles closed over here, right at the 200 EMA. So there was a rejection there. Um, so yeah, that's what I would do. So confirmation, wait for confirmation in the form of a bearish candlestick pattern. I can go over some candlestick patterns. I think Nico has posted it in the Discord a couple times. We can go ahead and find them and post them again. But there are some candlestick patterns that work on the daily, on the 30 minute, 15, 10 minute, doesn't matter. You can actually trade them. Sometimes you can even trade the same trade on the 10-minute time frame or 5-minute time frame. You can actually make the same trades um, maybe like in 5 or 10 minutes, and you can trade pivot to pivot because some of these candles, especially on Tesla you might not make a lot of money there. You're going to be struggling. If you're trying to scalp Tesla, you're in for a wild ride because it's very volatile. So for that, I would probably pick something like SPY or some kind of ETF that you can actually just. It's the same, somewhat the same volatility, but you're gonna have a different type of price range on the day. So like $1, $2. I know we've seen sometimes it does like $6 to $10, but that's a little crazy. Um, so same again strategy using the 9 and the 50 MA. Sometimes the 1 hour chart works. I like the 30-minute chart. Um, again, the 90 MA represents the short-term momentum. 50 EMA represents medium-term momentum. So this is the 50 EMA. This is the 90 EMA, right? The blue is the 90 EMA. So the 50 and the 200 are going to take a little longer and they're going to show more resistance than the 9. Once it's under completely the 9 is under completely the 50. Once that happens, you're going to start seeing that the price is going to start respecting the 9 EMA, at least on the 30-minute and some other time frames. So as long as it respects it, there's no reason to X or the put. exit the put. This also works when with the calls. Same thing. The 90 MA goes above the 50 MA. You want to stay on your calls and you want to put your stop losses right around where it needs to break. Sometimes they do go and they try to snipe like some of the stop losses that people put in the market. So that's why I kind of like to put them a little bit lower if I do set a stop loss. But most of the time I have a stop loss, mental stop loss. I know since a lot of people that are trading here are a little bit newer, so I always say if I post a play, I always say, hey, make sure you put a stop loss. So same thing. And with the 50 MA, you always want to make sure that it's trending downwards for the bearish, um, indicating a medium term bearish trend. So as long as the 50 MA is trending downwards, it's always going to be indicating like at least it's a bearish market or a bearish chart at that moment for that amount of time, as long as it's under. Uh, Let me see here. What else? If you really want to like set a stop loss, you can probably even set a stop loss like below, like just I mean actually no, not below. You can set a stop loss above the 50 MA or maybe like a recent high of the chart. So let's say if you're here, right? If you're here, let's say you're here and then you want to set a stop loss, you grab your position here. I mean, you can probably once this candle kind of fills and you're already into this one and you're already this one go, you can probably set your stop loss over here and then you can put it back over here. You can put it back over here. And then when you get over here, you can put it over here. So on this candle, you would have been out already. But you already took profits all the way from here to here. So this is what, like a 12, 9. This is a pretty volatile move. So you probably did like a $3 move right there. So maybe like a 45 to 50% trade there. uh, let's see here. And as far as taking profits with puts, a lot of the times the market, let's say like let's go back to SPY, I guess. But with puts, you always want to like start taking puts whenever this is kind of similar to the Tesla chart, obviously. But with profits, it's the same thing here. We went bearish over here, so we probably grabbed some puts like right here when it broke structure. You probably wrote it all the way down here, and this candle is kind of neutral in a way. That's why it started trying to recuperate here and go back up. So this would be like a reversal over here. This setup here, these three candles down here is somewhat of a reversal. And at the end, obviously, that's a reversal candle for me. So it wouldn't be good to stay bearish for next week, at least not for SPY. QQQ, pretty much same thing. QQQ probably gave the most, same thing as Tesla. But I mean, even over here, this candle here was a killer candle. If you went short here and you take profits here, and then you took a short position again over here when this red candle formed, you probably could have written all the way from this candle all the way to maybe over here in the middle, and that's a pretty big move. So, but yeah, candle setups, it's a big deal. Um, I think the volume indicator and the EMAs, they both benefit. They both benefit from being used in conjunction with like the broader market. So like the analysis of the market. So the sector performance, how good our chips are doing, how good is oil doing. Right now we're gonna have crypto. We already have some crypto ETFs, but a lot of these things, energy, etc. So a lot of those things are gonna. You also got to take into consideration, you know, uh, macroeconomics indicators as well. But you can always combine like these technical signals with like a fundamental analysis for like a more like a better trading strategy as well. So I don't think any strategy um guarantees success, but I believe that like the risk management and some other stuff, that has to do with like your position and how big your position is, how small your position is, what you're trying to get out of each trade, that's going to help you more than any of these strategies that you see up here. And you also got to build your own strategy. You can't just take Let's just say I'm saying the 50, the 9, and the 200. You start trading with that when you're already used to trading some other strategy. You got to kind of see how things are and what's going to work best for you. Pretty much. That's what I would suggest. There's plenty of charts right here that I could probably pick apart going into next week. Um, but if I just start saying, oh, a lot of the charts are bearish as hell, that's not really QQQ. This is kind of bearish here. Um, we have Apple going into earnings. This is the daily. It's bouncing up to 200 EMA. So I would say it's trying to hold the 200 EMA. So we're at 222. The 90 EMA is what 228, and then the 50 EMA is 237. 237. So ideally, there's a gap down over here. I'll put that on the chart because I think I have it in another setup, but I don't have it here. So let's say there's a gap over here that needs to be filled. And then if we go back a little bit, I don't think every time that it's hit the 200 EMA, it has bounced pretty good. So we're at the 200 EMA right now, and they have earnings next week on Wednesday. So if you see here, look, 200, 90 EMA, right? This is a daily. 90 EMA always respects it to one side or the other. So if you're looking at the daily and you're grabbing some kind of position, let's say over here, once it crossed, kind of just linger down. You want to kind of still looking at it over here, but once you get this candle here, there's no reason to be selling the stock. Maybe here you got a little bit crazy, but there's no reason to sell it because you're still not under the 90 MA. And then here you go. You cross the 50, and this is the big candle that we got. This is the big red day. There was probably some kind of announcement too that day. I'm not sure, but this is when you had the gap down as well. Gap down the next day. So somebody here knew. What is this? This is a 71 million volume right there versus, yeah. Somebody definitely had the in because you have a 55 here, you have a 61 here, and then a 71 here. So let's see, Microsoft. This one has earnings too. Microsoft actually flipped. It flipped up to the upside. So you have the 90 MA flipped up, it gapped up. So the 90 MA is above the 50 MA. This is bullish depending on whatever brings next week. So, but this is a bullish move here. So realistically, if they have some pretty nice earnings, we should be long on the stock. And then what do we have? So this is probably here 452 and then probably 460. If you have good earnings, 460 leaps will probably work, but they're probably going to be expensive as hell. I don't know if you guys have any questions about like the bearish analysis that I kind of did or how to find it. I can probably, dig a little bit deeper and try to explain it in a different way. If you have any questions, let me know in the comments, or I don't know if Nico wants to unmute people. I'm not sure.
Yeah, you got questions? You guys got questions? You guys got questions? Y'all understanding? You're not sure about something? Don't be afraid to ask questions. I'm learning too.
I have a couple questions. I want to make sure I'm looking at the EMAs right. You said the
hmm
yellow was 200, the 50 was blue, and the 9 was green, right?
No,
Or
so the 50 is the green and the blue is the 9.
gotcha. And are we
So
looking at this on the 30 the whole time? The 30 minute?
this is the daily now. We can
Okay,
do the 30 if you want. This is the 30.
gotcha.
So you see here we crossed down on the 30 again. The blue, the 90 MA crossed down on SoFi or Sophie. Um, but again, some people I like confirmation most of the time. Let's say, all right, let's do this because I think on Spy, I think on Friday, I think I gave a call out for I think it was on I want to say the 10 minute or the 5 minute. I'm not sure. But I gave a call out on SPY on Friday, not in the Discord, just like a couple friends that I trade with, and I said that it could retrace to I think at least like 608 or 608.50. I'm not sure. But I'm zooming in here. SPY did really well on Friday, despite like the ending, right? So let's say here. So I can't do today because we're not there anymore. Let's do the 10 EMA. Okay. So this setup here for me, this one here, this candle, for me right there, I already smelled blood. I was in the 10 minute. Um, I mean, we reached 610, which a lot of people were calling reached 610 last time that we went up. The market was going up pretty fast. We failed to hit 610 last time, and then now Trump is president again, and we got this bullish momentum going on, and we finally hit 610. Now this candle did not stay up here. It went all the way back down, kind of almost even a little bit even more less than the middle of the candle, the body of the candle. All right, so all right. Once this candle formed, right, which is right here, this is where the candle started. Once it formed, then I saw that it just went up a little bit and it couldn't quite get there. This is a long tail here. It means that they bought it back up at least to here. So this candle actually went all the way down here. If I would have bought here, thinking that it was gonna go under the 9 EMA, I would have been screwed here. So I waited for confirmation. As soon as I got the third candle, this is a 10 minute now. This is a 10 minute, not the 30-minute anymore. Okay, because we were trying to actually scalp because the market has been crazy and you don't want to get stuck on a position. If the market is bearish, you don't want to get stuck on a call. If the market is bullish, you don't want to get stuck on puts because it goes down pretty fast. And the zero DTEs, they get eaten alive by the time, especially after 1 o'clock, they start decreasing like crazy, like your money, pretty much your position. So what I did here is that as soon as I saw the next candle, the same thing, next candle open here and went up. It topped up on the candle right below, right before it, started going down. As soon as it enters half, this is my strategy. It might not be something that they teach you, or it might not be completely 100% bulletproof and might not work all the time, but this is what I do most of the time. If I see that I get a candle that got bought up, right? Red candle, whatever candle that got bought up before, and the next candle, this one, goes at least half, which I would get it like over here. This is the next support that it has. This candle meets this candle, that candle meets that candle. So as soon as it goes half of the candle or a little bit lower than half of the candle, which is over here, I start looking for puts. Best thing that happened on this one was that as soon as this crossed here, it just went down completely. I didn't quite catch it here. I think I caught it over here somewhere. The price was around here somewhere. I went back up. I said that I wanted to get 609 puts. I got 609 puts. Some of my friends jumped in there with me. As soon as it went back over here, it bounced all the way back down, even under the 90 MA. I was like, damn, all right, we're about to eat pretty good. And then it bounced right back up to the 90 MA. Sometimes this is really bad because this candle could just completely go all the way back up and void the setup. Now, my stop loss would have been here, which is my entry. Now my stop loss would have moved over here to get a little bit more of risk, just so that they don't raid my stop loss, pretty much. So even though I'm in profits here and this candle's forming, if this candle actually goes all the way up here, I'm gonna risk up here because I want to make money. So what happens if the candle comes up here and then it just rejects and then it comes right back down? So I'd rather risk a little bit of money. This is just my strategy. You don't have to follow it. You don't, just to put something in your mind, pretty much. But I like to get a little bit more risk if the candle starts going up. If it goes above here, then it's probably going to completely create a new higher day. And then I just let it go over here and follow my strategy pretty much. But this one played out perfect. went up a little bit, no pressure, and then it went back down. I didn't sell down here either. I should have sold down here. I didn't sell, but it worked out because the next candle didn't even make it up. It just went straight down. So I believe I sold off of the 50 EMA. That's when I sold, and I missed out on the other gains. But that's fine because it was a good trade. So I could have got some calls over here. This is the market kind of reverse. I didn't trade anymore that day. And then over here, look, this is the line that I just drew. Same thing. This is now it became resistance. And the other line that I drew. So if somebody got puts over here, if somebody got puts over here, they put like a stop loss over here where I had it before. And this is not me. I was drawing over here. There's no way for me to see this over here. But look, this is the resistance. So it would have played out. One, somebody would have gotten rated over here if they had a stop loss, a small stop loss here because the market has been booming. They get rated out, and then the puts leave without them again. Over here, same thing. This is the 90 MA, respecting the 90 MA, went over the 90 MA, didn't quite make it to resistance again, and then it just completely got stuffed by the 90 MA. Here's the market trying to retrace again. And then finally, this right here is a bullish setup, these two here. And obviously this candle's pretty good, so. But yeah, what Nico's saying too, yeah, you can do the next day 0 DT. Not like not the next day 0 T, but you can do like the next day ET. But you can do next day, the following day. Some of them might not move as fast as the ones that are 0 DTE because you're trying to catch a day trade right there and then. Sometimes I'm not even in the trade for more than 5-10 minutes, depending on how the market is. If I get a straight bullet down candle like this one over here on this side, then yeah, I'll stay maybe 30 minutes or so. These are 10 minutes. So you have 1, 2, 3. This is 30 minutes right here. And then you have 1, 2, 3. This is an hour right here. And then the next 10 minutes is this one. So like an hour and 30 minutes, you would have made maybe 200% or 300%, probably more on this trade on the puts. Doubt it. We see this very often going forward unless the earnings are bad. But you never know. You just gotta be ready. I like trading both sides. I have long calls that I'll just and the market is meant for it to go up because the United States economy wants to get stronger, etc. But you're gonna have these bumps on the road if it goes up or if it goes down in 1 year. I don't think the market has a lot of red years. I think it has more. Obviously, I'm pretty sure it has more green years than not. But you just gotta trade whatever you see, not just be stuck on one mindset on getting calls. Because sometimes you can get calls right away, right off the bat, as soon as the market opens. But what happens if it goes down? Unless you're getting it on Monday, you have 4 more days. You actually have 3 more days to be able to try to see if those calls are gonna work or not. Because by Wednesday, it's gonna be crazy. Is trading with EMA indicators the same on all time? Yes, it is. 1 minute, 2 minute. I wouldn't recommend doing it on the 1 minute or the 5 minute. I do it on the 5 minute every now and then, but you got to be quick. But on the 1 minute, you'll get cooked.
What's up?
What's up?
Right now we're going over puts and being able to apply it in your trading strategy. Hold on, Missy, I'm trying to talk. And applying it into your trading strategy. Trees put in a message separately. Nico doing puts? No, that's why I got somebody else that's good at puts doing these. Going over it.
Oh my God, is that your baby? She's sick too?
Nah, she just coughing. I don't know why.
She's getting sick.
No, don't say that, Missy.
Well, she's coughing.
Nah.
Mm.
She moving around.
Mm. It's going
Any
around.
questions on puts, y'all? Any questions? who does puts already? They're struggling with it. Who wants to start doing puts? Y'all know I only do calls. If you got any questions, please don't be afraid to ask. ECMoney is fire at this, so do not be afraid to ask. If you don't assume in this market, you don't want to assume anywhere in this market at all.
Yo, let me get some water and then I'm gonna summarize it a little bit better. So if they
All
have
right,
questions, just write it on the comments. I'll be right back.
all right, brother. Quick intermission. I'm gonna give you like 5 minutes to collect y'all thoughts. This week we about to eat again. We said them China stocks midweek. We ate during the end of the week. I gotta find whatever is gonna be moving again this week. We definitely gotta load up the clip. A lot of companies announcing earnings this week. A lot. So it's definitely going to be a lot of sectors that will be affected as well, right? So if FedEx announces earnings and they do bad, UPS can be affected as well. So same concept with all of the other stocks that will be announcing earnings. Hey, I know you want to sit up. Here you go. So make sure that you are prepared. You're not trading with most of your portfolio for sure when it comes to earnings. It is risky. It's like a scratch off almost sometimes. We were going over implied volatility. Implied volatility can change very quickly, right? So as earnings starts to come around, implied volatility increases. And once earnings occurs or happens, one of two things are going to happen. Let's say if they beat and the stock goes up, the implied volatility can remain around the same. So that means contracts will be nice and juiced. You'll make money, right? Or earnings comes out, they beat, and the implied volatility decreases. It's like that demand when fidget spinners were heavy on demand, right? Now they're not wanted. Same concept applies to the contracts. So the implied volatility decreases even though the stock went up, and you lose money even though the stock went up because the pricing or the factor that is calculated in premiums has decreased. So just be careful when it comes to earnings. These contracts can be pricey, very pricey. And if the implied volatility decreases, your money does too with that premium. So please just be careful. 5%, 10% of the portfolio is nice so that you're not risking too much. And if all else fails, you only lost 5 to 10% versus half of your portfolio off of hopes and will, right?
Yeah, that's the worst that could happen right there.
No. So just please be careful with earnings, especially earnings season. Earnings season can really make or break a week also. It can make up for losses and it can also add on to losses. So please just be careful.
All right, so I'm just go over it again one more time, and then I'm showing the spy the spy signal again, and then I'll tell you pretty much how this setup would work. All right, so EMA crossovers, short signal would be to, I guess, look for the 90 EMA to cross below the 50 EMA, or the 50 EMA to cross below the 200 EMA. It doesn't happen very often, but whenever that does happen, whenever the 50 EMA crosses below the 200 EMA, that's going to be like some serious blood coming in. Same thing with like upwards. If one of them crosses the 50 to 200, they cross upwards again, you get a big push. I'll show you right here on this chart that you're seeing for SPY. Um, so entry, an effective, an effective like short or puts entry might be when the price closes below the 50 EMA, and or like a crossover of the 50 EMA. So especially if the price is also below the 200 EMA. So if the 50 EMA crosses below the 200 EMA, it's very bearish, super bearish, especially on the longer time frames. I'm in the 4-hour time frame right now. Um, if the 9 crosses under the 50 EMA, that's like a short-term bearish move. Okay, meaning that you're probably gonna get a couple of candles down unless there's some kind of like reversals coming, and it'll probably start respecting the 90 MA. This is the 90 MA. This is on the 4 hour though. I have it here for a reason. Just give me a second. Support and resistance. You can use the EMAs as dynamic levels of resistance in a bearish market. Each EMA can serve as I would say like as a point where like price rallies. The price could rally if it goes above the EMAs again. So that's how you can kind of gauge between if it's a support or if it's a resistance. So for example here, the 90 EMA, this is supposed to be the resistance, right? This candle ended here, this candle formed here and went down a little bit, and then it went back up above the 90 MA, and then it went into the after hours. It went above the 90 MA pretty good. So the price is supposed to continue there, but it didn't continue when it opened. It continued afterwards, and then we get the big move. And then look, this is the 90 MA crossing, right? Up, all the way up, respecting the 90 MA. And then we're gonna have we haven't had the 50 MA cross yet, but we had the 50 EMA cross back here somewhere. This is when we started. Well, this one stayed above it completely, so 50. All right, bounced off again. So as long as it's above the 200, you have a bullish move. This is the 9 again. All right, here we go. There's the 50 EMA crossing the 200 EMA. All right. So we have the 90 EMA first crossing the 50 EMA, and then afterwards you have, I guess Nico can call this the golden cross as well. You have the 50 crossing the 200 EMA. Price is going to continue up. It's going to keep respecting the 90 EMA. Right here you had probably some kind of news. Over here you probably had some kind of news too, but still respecting it, respecting it. Price went back down, started touching the 90 EMA. Here's the price under the 90 EMA. So this is the 90 EMA under the 50 EMA, and you get the big candle down. You have the 90 EMA crossing the 200 EMA, and this is the huge candle, the huge red candle here. You're talking about 539, 549. So this is a $10 candle day, pretty much. So whoever had puts here, they probably made like probably 1,000%, probably more on this trade, probably more. And XPX completely cooked that day more than likely. So uh, price action with EMAs, bearish engulfing or rejection. You can watch for what we were talking about before. So you can watch for bearish candlestick patterns forming near or above the EMAs, which is what I was just talking about. You can have some candlestick patterns here. You have a hammer down pretty much, and then a long and body candle red down. Let me see here. So divergence. Don't really need to be talking about divergence. If the price is making new lows, but EMAs are not diverging as much, um, it might be a signal of like weak bearish. So pretty much, let's say this one here, we got it we got it pre-market. We got this candle here pre-market. This is a 4 hour candle. But if you got this candle here pre-market and then it went all the way down to the 90 MA and then on the 90 MA it bounced all the way back up, that was just like a trap pretty much. This is something that you don't really want to fall for. So you want to make sure that this actually finished the move. So if this red candle comes in, which was let me see, this was a $3 move. You want to make sure that when this opens, let's just say if it goes up a little bit, it has to go under the 90 MA for it to continue being bearish, or else you get smoked. I do 10-minute, but 10-minute on the same day, not 10-minute like 5 day or 10-minute 20 day. So I do the 20 today. It's not going to show because the market's not open, but You can also do the 5 day 10 minute to start with. That way you can see like the other days how they've been. So if I'm looking at this correctly, this formation here would say that it's an H, a lowercase h, this one here. So it means that the price should continue going down. But yeah, 10 minutes. You can do the 5 minute as well, but usually the 10 minute, that's the one that I've been trading off of lately. If I want to actually wait for confirmation, etc., I would probably do the 30 minute candles. So I would wait for one of these candles to close. Uh, it also depends too. I like putting like my support and resistance. So if I'm on the 30 minute and then I see this type of setup here, I will probably wait till around here. I will probably grab my puts here at 609. So 609, I will probably do like 608, or I will just grab in the money puts at 609. Even if it's in the money here, I will still write it down pretty good. Tesla, Tesla's hard to trade because sometimes it has a really big move up, sometimes it has a really big move down. So you kind of have to wait. And confirmation is key for Tesla, I believe. Earnings next week. To me, this indicates bearish, but earnings flips it around. And it's under the trend line here too, but it's been under the trend line a couple times and it pulls back up. The only difference would be this is the 90 MA. So we pulled the 90 MA and over here we're under the 50 and we're under the 200. Over here we were not. Over here we were under the 50, the 200, and then we went back up above both of them. So this is the 1 hour though. 30 minute respecting the 90 MA. Yeah, Tesla's tough. Tesla's tough. I think I think on Friday I said that it needed 420. I didn't make it to 420. I had this. Yeah, I didn't make it to 420. Got close. Let me see actually what did I say? So Tesla, yeah, 420.73, 423.33, and 428. So 428 because that was how high it went up the day before. But yeah, you see how Nico says the crosses are everywhere. That's where you trade. You can trade off of them. You can trade off rejections, or you can trade off of confirmation of going up. You know, rejection, get some puts, get 20, 30%, boom, you're done. Confirmation, get some calls, you get 20, 30%, boom, you're done. It's not always about like 100 or 400% or 200, 300% trades. Compounding is pretty much where everybody makes their money because you can have one trade that goes 200% and then the next trade goes on negative 100 or you completely lose it. That's where stop losses come in, but you got to be consistent. Compounding, I think most of the trades that Nico posts in the Discord at least does like 30 to 40% most of the time. If you can do 20%, let's say, I'm not telling you what to trade or how much money to trade with, but if you do the math, if you're doing $1,000, 20% of that is $200. 25% of that is $250. How much are you making at your daily job right now? How much are you making monthly? What is your goal? Those are things that you got to look at. Who's making $300 in one day or in 1 hour or in 30 minutes? Some of these cons that go up 30% right away or 40% right away or 25% right away or down 20% right away. So if you're waiting for confirmation and you're disciplined enough to be able to jump in and say, hey, I made my 30%, 30% of 1,000 is 300. I'm good with 300. Tomorrow I'll be back at it again, or maybe I'll just wait till like 3 o'clock and put in another trade and see how I do. And then I'll just risk 50% of my profits that I just made today. You're still up what? If you're making 300, you're risking 50%, you're still up 150. So that's $150 you didn't have before. If it goes the same way, if you're trading with 5,000, 10% of that is 500. It's just simple math. You just got to know what you want out of each trade. I'm not telling anybody to put a 500, 5,000 or 10,000. Some people do trade that, but just make sure you know what you're trying to get out of each trade.
Any questions? Any questions? Ask away. Makes sense, Taja.
I was gonna say one more thing that I kind of touched up on for the premium trading. Um, Maybe we'll have another Zoom for this, and I'll probably be a little bit more prepared for it because right now I'm just thinking about my couch and freaking watching a movie and then I don't know, going to sleep pretty much. But I see a lot of people they use the VIX as a volatility indicator, right? Um, it's good to look at those. It's good to look at the VIX because it gives you like the implied volatility, right? Implied volatility, like high implied volatility, can lead to higher premiums, which is pretty much beneficial for like sellers. You can use the VIX or maybe other volatility indicators to gauge the market fear and adjust your premiums accordingly. But don't be fooled because sometimes the VIX will start to go up, but the market is kind of standing a little bit neutral. Just because the market goes down maybe 50 cents or 70 cents, sometimes even a dollar, doesn't mean that the VIX is about to completely explode. Those days are pretty much behind us. I think those days are back in maybe like the early 2000s, 2005, 2006, 2002, when the market is moving maybe like 30 cents and people are freaking popping champagnes, and right now the market is freaking moving like $10 sometimes in a day. So I would just kind of, if you're doing like options, yes, watch the VIX. Also look at the theta on all your options because that's really big, especially if you're in 0 DTE or if you're like on a weekly trade where it's just not going right for you from the beginning. Sometimes it's best for you to just let it go and then just reposition later because it's not worth it to be down on a trade 50, 60% and then wait. Sometimes it does pan out and it's great if it pans out, but it's best if you just let go of the trade and then just enter at another point where you have a little bit more confirmation that it's going to do what you want it to do or what you're seeing on the chart. So volatility, time decay, which is the theta on every contract. We can go over that or we can post something on the Discord a little later for everybody to read a little bit on that because it's really important. It's called the Greeks, and that's very, very important if you're trading options. Um, Delta hedging, which meaning if you're selling options, you should consider delta hedging to manage directional risk. So if you're selling something and you feel like you need to hedge because you think that it might be going up, then you might want to hedge with a call as well. So that's another one. Um, and it's better. It's the best thing for this market that we're in right now because the market right now is unpredictable, and I think delta hedging is something that a lot of people are missing, and they don't know what to do when a position goes the opposite way of what they're planning on what they're planning for it that it's going to do for them. Liquidity, ensure the options you're trading have sufficient liquidity to enter and to exit positions smoothly. Meaning that if you see an option that has a lot of spread, as far as like the bid is at 50 and then the ask is at 70, that's a no go. If the bid is 50 and the ask is 70, just bid sit at 50 or bid sit at 55 and see if you get filled. Because if you fill at 70, you're gonna be upside down as soon as somebody hits that 50. So it takes a while for the stock to get going. I see this happening sometimes on, I don't know, some stocks that don't really trade a lot of options. They're just known for people that actually just buy the commons. It happens a lot. So sometimes you buy $1,000 worth of an option at 70 and then the bid is at 50. Whenever they hit that 50, you're down right away. Like Nico's saying. And the last one for me, I think, is just the market sentiment, which is a lot of people sometimes the market hasn't even opened. They don't know how the market's doing. They're just like, oh, we're just going with calls right out the gate. I mean, if you have a plan, yeah, please go with calls. You know, just keep an eye on the broader market sentiment because sometimes, especially now, I know we have a new president and hopefully he does really good. I'm pretty sure he will. But you never know. Negative news or economic indicators can reinforce bearish trends or bullish trends. So potentially increasing option premiums due to fear or due to people a little bit more at ease with whatever is going on. So just a reminder, we still have a war over there in the east, Russia and the other guys, Ukraine, etc. There's plenty of soldiers still down over there in Iraq and those other countries. There's still like things going around. You know, Trump is going to try to make a lot of moves. I think the market's going to be all over the place, but you just got to see. You know, I think you just got to trade whatever's in front of you and just forget about forget about everything else and just have some leaps here and there for stocks that are the hit right now. So before, obviously there still are, but the chips are really big still. Energy stocks are really big still. So Nvidia, Tesla. Now we got quantum coming in the picture. We had AI before. I think AI will do well as well because a lot of people are investing in AI still. Um, but you just gotta keep an eye on everything and then see. I hope this helped you guys. I don't know if you have any questions, but I think that pretty much covers everything. We'll go over some other stuff like the premium trading overall, and then also like the VIX and the Theta, which is the Greek. Those are important things for you guys to know as well.
Any questions, y'all? Any questions?
I probably put everybody to sleep. So
No, I'm listening. It's just
No, I'm listening. I'm listening.
more of a writing it down and then doing it. Obviously, I'm more of a I have to do things to learn things, apply the things that he has gone through.
yeah,
They digesting. They digesting. Did this
no,
help
that's good.
anyone? Does this help? My bad. Go ahead, Easy.
No, I was just saying that's good. If you're gonna try out a strategy from anybody, whether you think is a good one or whatever, just I would still recommend to not paper trade. I would recommend to just do it with $50 or $100, just so you can get some skin in the game. And I always recommend this to everybody. Uh, I mean, I don't think anybody here. All right, if you do it, that's fine, that's good, whatever. I don't think anybody here or even a lot of accounts on Twitter and some other places, etc., should be using a margin account unless they know how all these things work. Because a margin account, if you click one wrong button and you hit submit and it goes the opposite way, you could lose a lot more than what you have on your account. Okay, so switch to a cash account and only use a margin account later down the road if you really need it. A cash account is just as good. It just means that you can do certain stuff like you can sell calls, you can sell puts, which is different than buying puts and then selling the puts. So those are different strategies completely. Uh, and you have a lot more risk when you do that. So switch to a cash account if you can, call your brokers. If you're good with your margin and you don't think you're gonna mess up, that's good. That's on you. But I would strongly recommend cash account for now. Later down the road, when you learn everything, you know exactly what kind of risk you're taking with a margin account, then you can go for it.
Makes sense. Makes sense. Y'all got any questions?
Yes, makes sense.
Y'all want to wrap it here, or y'all want to go over something specific? I'm still on daddy duty, so y'all might hear some every once in a while.
I'm curious about like cash secured puts. What it like? How does that work? If is that something that you guys do?
You can do a cash secured puts to grab the premium from it. Um, you can probably, I mean, it works well. I've gotten away on to do that. Right now, I do a lot of straddles and strangles. But what is your actual question from it though?
Well, I just don't know. I don't know how to do it. I mean, I've never had done it before, so I was wondering if that's just another way because I know I don't know if it was you or who it was that had posted on the group about that there's more ways to work the market in your favor other than just calls and
Hmm.
puts.
Yeah,
And
naked calls, naked puts.
yeah, and then there I see that these all these other things are available in the platform, and I just was wondering if you do it and you say straddles and strangles, I don't know what that is either.
Yeah, I'll explain that to you. So, all right. So when you're selling a put, right? So you're selling a cover put. It works very similar to just grabbing a regular put, but you're basically you're deciding to sell a put option on a stock you're interested in. Okay. You don't have to. I don't think you have to own the stock. Okay, but you choose a strike below the current market price. So let's say if Tesla is at 406, let's say Tesla's 406, you're gonna choose to sell a put at 400. Okay, so uh, I mean you might want to sell a put option with a strike price. I would just say maybe like a $5 difference. So let's just say a 401 strike price. That's just to keep it simple. So 401. When you sell the put, you receive a premium from the buyer of that option because someone is putting their shares for like pretty much for how to explain it. Someone is borrowing is letting people borrow those shares pretty much. So you're receiving a premium from the buyer of the option. So the premium is yours to keep regardless of whatever happens with the stock price by expiration. Okay. So you receive like let's say three, blah, blah, blah. Let's just say an example. You receive a $3 premium per share for the put option. So the same way that you're having the same way that you have the same way that you will be selling uh, I don't know a put for $3 because it got to $3. It's basically the same thing. I don't know how to explain it a little better. I'm like thinking about it in my head because I've done it, but you pretty much receive the premium price per share for the put option. So 100 shares, and that's a standard for options contract. That's like $300 if you're getting $3 premium per share. So you're selling the put. You're selling the put option. I don't know if that makes sense for you.
I see what you're saying. Yeah, like you're actually selling the put itself, not the contract. Like
Correct.
you were to do if you were doing a put and a not in a call.
Yeah,
Okay. Thank you.
no problem. It works the same way with the cover calls, but I believe with the cover calls, I've never sold a cover call that I don't own. So for example, on Tesla, I do that a lot. For puts, I'm pretty sure you don't have to own the stock, but I don't think so. You when you sell a cash secure puts, you're pretty much agreeing to buy the stock at the price. You're agreeing to buy the stock at the price. If the option is exercised, you don't have to own the stock, but you need to have that's why I kept on saying about like the margin. You really actually do have to have sufficient cash or margin in your account to cover the purchase of the stock if you are to exercise it. If it gets exercised, you have to have that. So you're saying, let's say Tesla is $400, and let's just saying you're doing I don't know, three premiums. So three times 100, that's 300. So 300 times 400, that's how much money you need to have on the account in order for you to be able to cover that. So that's why it's called cash secured. So a cash secured. It means that you have to have enough cash on your brokerage account to cover the cost of buying the shares at that at the strike price. So if you sell an option with a strike price of like 50 on 100 shares, you need at least 5,000 in cash or margin available to be able to have that, to be able to do it.
That makes sense now that you put all the other factors in.
Yeah. Always remember, guys, like even if we're getting like regular calls and regular puts, each contract that you get, if you get exercise, which nobody wants to exercise them unless it's like a stock that's about to run up like 20 more points, you're actually paying. Let's say if I'm getting Tesla $400 calls, just an example, and I'm getting 100 of them, right? 100 contracts of them. I have to do 100 times 100 because each contract is 100, is 100 shares. So 100 times 100, and then that times the price of 400, which is the strike price that I got. If I want to exercise it, they're gonna say, okay, the stock is at 420 or 430, and you got a premium at 400. So that's you get to keep that position if you want to. Now you can either sell or not exercise the contracts and then just cash in whatever you made percentage wise on the options, or you get to purchase a stock at 400 times whatever cons equaling the shares that you got. So if you got, what is that for? Is what is that, 400,000? Is that
That
400,000 or
400K
40,000?
or 40,000?
Yeah, one of those. All right. So either one, you get to have 400 XYZ, whatever it is, at $400, which is the stock price. Then then the stock is at 420 or 450 or 500 or whatever. So you do the math at that point. 400 times 500. That's how much you would have if the stock is at that point. You know. So yeah, I mean, it depends. All those little contracts that we're getting, that means that we're each contract is 100 shares of that stock. Each contract of a SPY is 100 shares of that ETF. So that's 100 position of that ETF. So that's how it works. Um, I would say like if the stock, going back to you, Honey Badger, if the stock, what I would say is, if the stock, like, I would say like if the price stock, like like if it falls below the strike price at expiration, or if it has an option to be exercised early, this is what I was talking about before. You'll be assigned the shares at the strike price, which you might consider a good deal if you want to own it, or a bad deal depending on the strike, no, depending on the stock price.
So trade what I would want to keep if shit goes the way that I don't want it to go.
Yeah, I always do the math, and always remember, like if you're actually like what Nico was saying, if you're doing naked shorting on a stock that is as volatile as Tesla, and you're under, like you will get calls right away. You'll get plenty of calls asking you to put more money into the account, or I've seen some cases that are pretty bad. I don't know if you guys remember the story of the guy that woke up like the next day. He woke up like $700,000 under, and I think he had like $120,000 in the account before that. So it could happen.
I remember that one.
Yeah, I think he killed himself actually, I
Committed
believe.
suicide. Yeah.
Yeah. So, but yeah, in summary, you're selling cash secure puts. That's a strategy where you do not need to own the underlying stock, but you must have the capability to buy it if the options are exercised. So a lot of like what you're saying right now, for example, like the cover calls and the cover puts, a lot of those strategies, they're usually used by like people that are like, they're just trying to look to generate like income or buy like regular income. Like let's say I want to collect a $500 premium. All right, here you go, boom. Or they want to buy the stock at a discount while managing like a risk exposure. But if it goes sideways, it could go sideways pretty quickly. So I'd rather just stick to regular puts, regular calls. Sometimes I do buy like a call. Let's say like if a stock is at 150, I'll buy the 150 and then I'll go ahead and sell the 151 if I own that stock. I buy the 150, I keep the 150, and then I sell the 151. And then I'm securing myself some kind of profit from there, and I just ride the 150.
Yeah, that strategy has been working for me. I followed uh, Nico on that, like with getting the multiple contracts, leaving a runner and whatnot, and been trading like smaller contracts
Yeah.
just to practice, and then obviously studying the contracts that didn't go the way that I wanted them to go, and see where I made the mistake or what did I not catch. But you saying you trade on the 5 and 10 minute?
I trade mostly on the 10. Sometimes I go down to the 5. And then for confirmation, if I have more time, I trade on the 30-minute. So
Nice.
you want to have like
Mm.
you want to have like 3 to 4 screens up most of the time. So if I'm in a position, I have the 10-minute, which is the one that I'm trading off of, and then I have the 5-minute, which I'm looking at to see what kind of move is incoming, and then I have the 30-minute to see where the stock could be heading. Pretty much. The 1 hour, you can use the 1 hour as well, but I think the 1 hour and the 4 hour are more to see like what kind of trend is having. But if I'm usually just either scalping or I'm trading maybe for half the day, so I don't really have to stay around that long.
That helps a lot actually, because I was looking at all those time frames and I noticed that it does kind of give you a better idea of, because you could go to the 3 minute and you got green candles, but then you switch to the 30 minute or to the 1 hour and it's a
Mm.
red candle, not a green one. So it
Yeah,
kind of shows you overall um, during that time frame, like, is it going to be green or is it going to be red?
yeah. So this is something that I kind of would like everybody to try, right? And you can give me your platform, and I can try to find a way of doing it. But just, I don't think there's a way of making every single candle the same color. Maybe there is. I can look around, but you don't need to see green or red most of the time. You can just see whatever candles there are. All you need to know is the closing of the candle and the momentum of the market. That's why a lot of people see my setup and they're like, "Oh, what does the one that's hollow mean and the one that's full?" If you take a look, all the ones that are hollow are the ones that are green, all the ones that are full are the ones that are red. It could be completely the opposite way. There's other styles here that I have that will probably work differently, and then it'll be completely different. So let's see. Uh this one's pretty messy. Uh, So let's take a look at the. Let's take a look at this one. This one's pretty messy. To see these are full, and then I have some yellow candles, and then sometimes these yellow candles they turn into red candles. But I don't even look at the color anymore. I really don't even see you have red candles here. I barely ever look at the colors anymore of these candles. I just see whatever candle is coming in, what the formation is, if it's a bearish formation, if it's I mean, this chart here has pretty much everything. Even at the bottom, it has indicators. I barely ever use this anymore. But you have a lot of, you just got to look at the trend. This is a trend. This right here is a trend down. You have sideways. And then you have the next candle coming in here. And there's another trend going up. And then you have a little bit of sideways. And then you have another trend going. That's all you got to look. Forget about the colors. But yeah, the daily, I'm sorry, the 5 minute or the 10 minute, it does help out a lot. Um, I do have three charts. I have whatever I'm trading at the 10 minute, then I have the 5 minute to see what it's doing or what's incoming, and then I have the 30 minute to see what kind of trend it's having. Uh, it makes a big difference if you put it on intraday or for today, or if you put it on the 5 day chart. You can put any time frame on any of those. You can do a 10 minute on the 5 day. You can do a 10 minute on intraday, or you can do a 10 minute. Intraday is like today, pretty much. Or you can do 10 minute for one day, and then it'll just be whenever it started that one day. Uh, but yeah, no, that's it. If you want to know what straddle is, I can show you. It's very simple. Is you're pretty much picking an opposite side of whatever you're getting at first. So if you're getting, let's say on Tesla on Wednesday, I'm probably gonna do a 420 call, depending on where it is. Just an example, I'm gonna do a 420 call, and then I'll just do like a 420 put at the same day. So, and that'll
So
probably go ahead.
no, you go ahead. I'm sorry.
No, that's it. It's you buy a call option with a $420 strike, and then you buy a put action with a 420 420 strike. And the price, you want to keep the price of each one. You got to make sure that they're kind of aligning both. So let's say if it's a $3 for the call and then $2 for the put. Just an example. You want it to be kind of like a dollar or a dollar and a half close to each other.
So it'll offset any losses in case your call doesn't go the right way.
Well, yeah, I mean if Tesla moves, like let's say if it moves, I don't know, if it moves above 425 or below if it moves above 425 or below 415 by the expiration, you will start to profit there.
And this is a straddle, you
It's a
said?
straddle. Yeah, it's a
Okay.
straddle. If it remains at 50, you lose the entire 500 premium. This is like with your margin account though. It wouldn't be with like your. You can do the same thing, but it wouldn't pay out. It would pay out differently
Hmm.
because obviously you can't keep it till the expiration because you're gonna be losing everything.
Time decay. Ugh.
Yeah.
Hey, that's pretty simple.
Yeah. I wouldn't. I'm probably gonna do it, but more than likely, I'm probably just gonna sell some calls because I already have like a lot of Tesla comments. So I'm probably just gonna sell some cover calls.
Anybody else? Anybody else? I guess not. Any specific topics? So we're gonna wrap up tonight. Too much info for your brains today. Good luck, CC. Thank you very much, brother.
No worries, bro. I will kill it next week for sure.
Oh, for sure. We're gonna wrap it up here. Let me know if you need anything at all, y'all. We back at it again. I posted the
Thank
earnings.
you, bro. Thank you.
I posted the earnings report and the expected moves. So if it is a high expected move, don't forget, yes, it can move 10%, 20%, whatever it is, but we can still get IV crush. So still make sure you're trading accordingly. Don't be putting half your portfolio into a trade for earnings, please. If you can, y'all thank EC and Discord for his info, if you don't mind, and y'all have a wonderful and blessed night. Peace.
All right,
Bye.
guys.
Bye.
Take
Feel
care.
Thank you,
better.
bro. Thank you. Thank
No
you.
Girl.
worries, guys.
Thank you.
Bye.